all of the political and economic, but mostly political changes going on in our country and around the world, things are moving at a fast pace and they're changing quickly. And it's kind of head spinning to try to keep up with it. But it's affecting the markets, the stock market and bond market. And I will get into that. The AI revolution is also affecting the same. So a lot to uncover here, and look forward to explaining it. My name is Ben Reppond. Welcome to my YouTube broadcast. Today is February 4th, 2025. Okay, I'm going to begin. I'm going to play three pieces for you today. One of them is a piece by David McAlvany. It's a podcast. He does a great job of explaining what's going on in the AI revolution, the impact of DeepSeek versus ChatGPT, and the disruption factor, the magnitude of that, what it means for the market, what happened this past week, past Monday when it was announced. And so a lot there from David McAlvany. So I think you will appreciate it. It's just and a good analogy that Kevin Orrick uses to explain it. So take a listen to this, and then we will get into the impact. I want to give you two views of the impact that tariffs or potential tariffs from our country are going to have on the economy and the market. So take a listen now to David McAlvany.
I was thinking this week, Dave, when we saw DeepSeek come out. We can talk about that through the show. But I love South Pole history. I love Ernest Shackleton or Robert Falcon Scott or Roald Amundsen. And it reminded me of the story. You probably remember this, but in January of 1912, a very well-stocked team of 65, it started with 65 people. The last 5 to push to the South Pole for the English was Robert Falcon Scott and 4 other guys. 65 people, hardware heavy. They had dogs, they had ponies, they had motors that they had to move. But there was a shock when they got there on January 17th, 1912. A Norwegian team had gotten there first.
Almost a month earlier.
And they had 19 guys. 19 in, 19 out. No one was lost. The Norwegians beat them. It was very light on the hardware. Scott was heavy on the hardware. And unfortunately, the 5 that went in and came back out, all 5 were lost for the Scott team. So, I'm wondering, Dave, if NVIDIA isn't a little bit like the Scott team right now, hardware heavy. And then you had DeepSeek this last week come in and say, hey, you don't need that much hardware.
Well, that's exactly right. You had a decline of $589 billion in a single day. And that marks the greatest concentrated single company loss in financial history.
Wow.
In a 24-hour period.
Almost $600 billion lost.
Forbes reports NVIDIA's nearly $600 billion market cap loss Monday is larger than the individual market values of all but 13 American companies. More than the market cap of titans like health insurer United Health, oil giant ExxonMobil, and retailer Costco.
Wow.
And, at issue, if Chinese company DeepSeek can do what the large language models do at a fraction of the cost with a fraction of the hardware, then you're looking at the AI supply chain in that sort of Wile E. Coyote moment.
Wow.
Gravity is in effect. And so the claim is that this more efficient open source application was built for under $6 million, uses fewer than 10,000 chips versus the hundreds of thousands, actually millions of chips required by its competitors at a cost stretching into the billions of dollars. So this would be the beginning of the AI revolution in terms of its applications and iterations globally. Can't underscore enough the importance of that open source nature. And it would be the beginning of the end for your AI tech firms that are pricing in 30 to 40 years of chip demand into the current market capitalization structure. Mark Andreessen, says this is the Sputnik moment. DeepSeek's R1 is AI's Sputnik moment. And there was a gentleman who's in conversation with ChatGPT. ChatGPT said that DeepSeek architecture replacing the dense large language models, LLMs, demand per unit of AI output is likely to decline by 80 to 90%, assuming similar productivity levels. So you're talking about the graphic processing units that NVIDIA makes. If what DeepSeek says they can actually do, you're talking about a significant upset.
It's amazing that ChatGPT, our listeners can go to ChatGPT and actually ask about the death of this version of AI being replaced by another. And it's like, yeah, you're right. Even NVIDIA came out and said, oh, well, this is a good development.
Do you remember the conversation we had with Mark Faber and his classic quote? There's like a moment pause and he says, "We are doomed."
That's right.
Well, it's interesting that DeepSeek announced its app the day of the inauguration. And the week that Trump announces a $500 billion initiative to lead, and for the U.S. to lead the AI revolution in partnership with Larry Ellison of Oracle, Sam Altman, the team at ChatGPT. Don't think for a minute that the Politburo in China wasn't briefed on the initiative, the announcement, and signed off on the timing. Mere coincidence? I think not. As the U.S. asserts its global dominance via a more muscular Trump 2.0, overnight, we're not the leaders, we're the laggards, not the leaders in this revolution, assuming that DeepSeek claims check out.
Well, yeah. And, Amundsen's camp basically had a flag there with Norway right there on it. And in a way, I'm not going to cheer for a Chinese victory here, but we have to watch out, Dave. When something doesn't feel like it's quite right, usually something shows the vulnerability and shows that it wasn't quite right.
Yeah, I think you'll recall our comments in recent commentaries comparing the current period of AI enthusiasm to the dot-com era.
Sure.
In the internet revolution of the 90s. And revolutionary it was. The underperformance in tech for the 15 years following the run-up tied to overvaluation of those equities requiring time to digest the blow-off levels of enthusiasm. That's what happened next. Yes, it was a revolution. Yes, it's changed life as we know it, how we function, the habits that we have, that we have social references like screenagers, which I have a few of them. That's only possible because of the proliferation of the internet and ultimately the devices that complement it. Ray Dalio concurs this week in a Financial Times interview. He says, we're in the cycle right now, which is similar to where we were in 1998 and 1999. In other words, there's a major new technology that certainly will change the world and be successful. But some people are confusing that with the investments being successful. He couldn't have said it better. There's the rub. The revolution is upon us. But what is likely to be disappointing is the investor expectations of continued success in those particular companies. The radical increase in efficiency implied by DeepSeek models imply a much faster and more widespread adoption of AI, but it's far less constrained by energy consumption. So we had a significant hit, not only to NVIDIA, but other companies in the AI space. And on the same day, NVIDIA shares dropped like a stone. So did the energy companies with closest ties to the grid expansion needed to power data centers and needed to support the LLM proliferation. Constellation Energy, NuScale, NextGen, a host of other nuclear names were tagged for between 15 and 30% losses. And as a team, we've had for many years now an interest in uranium. But our interest in uranium, I'd say over the last 24 months, has been held in check by concerns that AI enthusiasm was mispricing those assets as well. And thus we've tiptoed through that space. We are slated to expand exposure to the space, but have said repeatedly in the office that we need to see the AI bubble burst prior to major allocations being made.
So now I'm going to give you two views on tariffs and their impact on the economy. I try to say very apolitical, so neither one of these are really that political. Both of them see that tariffs, can be a good thing and that there will probably be some negative impact on the economy. But they don't approach it from what I can tell from a political perspective. The first is from Professor Jeremy Siegel from the Wharton School, and he gives his view, which I happen to agree with. So take a listen to Professor Siegel.
Jeremy Siegel, Professor, it's always good to have you, especially when we see a market doing what it is on these headlines. Your reaction is what?
Well, I think, tariffs are the only negative of Trump's economic agenda, most of which is very good. I also, by the way, wouldn't completely give up hope on a settlement. I know a number of people, including myself, that have been in a jury room, selected for a jury, and we're ready to go. Lawyer comes in the last minute and said, hey, we have a settlement, and we all leave. I can't guarantee that, but, the art of the deal for Trump, let's push him to the edge and see what happens. But clearly, if it is 25-25 and then 10 on China, that is a negative impact on the economy and I think on stock prices.
But then why do you have people like Jamie Dimon, who I think it was in Davos, said get over it, essentially as it relates to tariffs? Lutnick, as I said, the proposed Commerce Secretary, saying the notion that these are just across the board inflationary is nonsense.
Well, it's not nonsense. There is some positive effect. Is it a disastrous effect on prices? Probably not. I mean, I've seen some research that suggests if all those tariffs come in, and don't forget, trade is only 10% of GDP, and if all those tariffs come in, it might raise the price level by a half or 0.75%, and that's a one-time increase. So, I wouldn't call that disastrous, but that certainly reorganizes supply chains, all sorts of sourcing situations, and it really depends on how long it lasts. I mean, if he puts it on Saturday, I think a lot of people are going to defer for a few days, and then he could reverse it on Monday or Tuesday if another concession is wrangled from Mexico and these other countries. So it's a bargaining tool. Are you going to get enough in exchange for the negative effect of the tariff in and of itself? And I don't think this play is over yet.
This past Monday, the 3rd of February, the market took a hit. It recovered quite a bit, but initially it started out way down. And the reason for it is agreed upon, that the reason for it was the announcement, specific announcement of tariffs on Mexico, Canada, and China, and the potential of tariffs being used on other countries for us to get whatever we're trying to get, I guess, the negotiating leverage. And so the Tom Lee from Fundstrat discusses the impact of this, and he points out, and I think this makes sense, I don't think how many people have really thought this through, but when Trump comes out and he says, okay, I'm going to put this tariff on you and that tariff on you if you don't do the following. So all of a sudden what the market does is it reacts negatively, which is what it did over the weekend, reacted negatively. What is not seemingly factored into it is that what if the other side agrees and makes the concessions? Well, as I speak, I'm recording this actually on Monday, as I speak, Mexico has already conceded and struck a deal. So that 25% is apparently off the table. So now you've got China and Canada. Was that kind of a shot across the bow to see their reaction, a negotiating point from which he can, negotiate from? I don't know. He tends to do that, so maybe that's the case. So, but the market rallied today up from its low, and I think that was because Mexico had agreed to the concessions. He points out also that what about other countries? Our country, we may have a negative impact on our economy and maybe the stock market for at least a period of time, maybe, in my opinion, maybe a short period of time, but then some kind of recovery, at least in the market. As far as the economy goes, it's hard to tell. We have not had tariffs of any significance since 1920, 21, and we had them in 1870. So today is a different world. So he says that if other countries have negative impact, what they will do, their central banks will just print money, which is what seems to be the way out of all problems these days. And what that does is increase worldwide liquidity. And again, money's got to go somewhere, so it usually goes into the stock market and into real estate. So basically, it's probably going to be positive for the market, even if other countries initially struggle with the tariff issue. But anyway, take a listen. I like Tom Lee. I've tracked him for a period of time in what he says or predicts, and it's been pretty accurate. I know there are people who don't agree with him, but it looks like what he has said, most of it's come true, and he's been fairly spot on with some of his predictions, particularly about the market. So take a listen to Tom Lee.
Our next guest says that he is bracing for the markets to overreact to President Trump's tariffs on Canada, Mexico, and China, and would advise investors to buy the dip. Tom Lee is head of research at Fundstrat. He's also chief investment officer of Fundstrat Capital, as well as a CNBC contributor. And Tom, there's not a huge dip here. We're talking about declines of 1.5% or less for the major averages at this point. Is that the dip you're talking about, or you think there's more overreaction potentially to come?
Overnight, it was actually, I think when futures opened, it was almost twice the decline. So the small caps were down 4, NASDAQ down over 3. It's good to see sort of markets are catching their breath. It's the second Monday shock, right? Last week was DeepSeek. Right. But I'd say actually it's almost a victory that if we open only down 1.5%, because I think there was quite a lot of panic over the weekend.
Yeah, look, the market to this point has kind of operated on the idea that this is a negotiation that's taking place, that these tariffs, if they are implemented, won't last for long. Is that your thought process as well still?
Yes, I'd say there's decent odds that, let's say we go 3 months out, that the tariffs will be rolled back because concessions were received. And there are also other mechanisms in place to sort of protect markets from the downside. I know people think this is an unlimited risk scenario for stocks, but if the tariffs come into play and other countries go into recession, those central banks will be easing, which will actually improve liquidity. So I'd say that as bad as things look, I do think there's downside protection.
Okay, hopefully that was helpful. Thank you for watching. If you have questions or comments, leave them in the comment section below.